Welcome to this explainer. If you've ever looked at the financial markets and just felt completely overwhelmed by all the jargon, you are absolutely in the right place. Today, we're taking the complex mechanics of options trading and making them crystal clear. We'll be using some brilliant, everyday metaphors directly from our source material to really make these concepts click.
Okay, let's kick things off with a slightly counterintuitive question. How exactly can you make money when the stock market is actually falling? I mean, for your traditional stock investor, a market crash is an absolute nightmare, right? But in the options world, a downward trend is literally just another opportunity. It takes a fundamental shift in how we think about risk and reward, and honestly, by the end of this explainer, it's going to make perfect sense.
So, here is our roadmap for today. We're covering 1. Options versus stocks. 2. Calls and puts explained. 3. The Greeks' options mechanics. 4. Buying versus selling. And finally, 5. Basic option strategies.
All right, let's jump straight into Section 1, Options versus Stocks.
Now, while buying traditional stocks requires a pretty heavy chunk of capital to control a decent number of shares, and you're mostly relying on the market going up to make a profit, options are this incredibly versatile, highly leveraged alternative. With options, you only need a relatively small amount of upfront capital to control a much larger position. Plus, you can construct trades to profit whether the market is moving up, down, or even just trading sideways.
But, it's not just about the leverage. Options give you a really powerful toolkit. A huge benefit here is defined risk. Basically, if you buy an option, the absolute maximum you can lose is your initial premium. That's the price you paid for the contract. Your downside is strictly capped. On top of that, they open up cool ways to generate income even in stagnant markets and give you the flexibility to hedge against risk in your existing portfolio.
So how do we actually do this? Let's move to Section 2, Calls and Puts Explained.
The source material sets up a really perfect binary for us. Calls are for the optimists. These are traders with a bullish perspective who expect an upward swing. Think of it kind of like pushing a playground swing higher and higher. Puts, on the flip side, are for the pessimists. They're negatively coordinated with the market, making them a bearish tool, perfect for when you expect that downward teeter-totter motion.
Let's break down the call option first. The most crucial thing to remember here is that when you buy a call, you are purchasing the right, but definitely not the obligation, to buy an asset at a predetermined strike price before a specific expiration date. You're basically locking in your purchase price. This gives you control of the asset without dropping a massive amount of cash to buy the stock outright.
Think of it exactly like buying a ticket to a highly anticipated concert in advance. You pay a premium just to secure your entry at a fixed price. Now, if that band suddenly blows up and demand skyrockets, your ticket becomes insanely valuable on the secondary market. But if the concert gets canceled or you just decide not to go, the absolute most you lose is just what you paid for the ticket in the first place. Conversely, let's look at the put option. This contract secures your right, but again, no obligation, to sell an asset at a predetermined strike price before it expires. So even if the actual market price completely tanks and drops way below that strike price, you still hold the legal right to sell your shares at that higher agreed-upon price. A great way to think about a put option is like an insurance policy for your portfolio. When you own a house, you pay an insurance premium to protect yourself in case of a fire, right? Well, with stocks, you pay a premium for a put option to protect yourself against a market crash. If the market tanks, your portfolio obviously loses value, but you can essentially claim your insured value by exercising your right to sell at that higher strike price. It effectively stops your bleeding.
Now that we've got the basics down, let's dive into Section 3, the Greeks, which really gets into the options mechanics. You can think of this like the dashboard for your options trades. Just as a pilot relies on their instruments to fly a plane, options traders rely on the Greeks to measure exactly how much their options price will fluctuate based on different variables. We've got delta for price sensitivity, gamma for the rate of that change, theta for time decay, vega for market volatility, and rho for interest rates. Let's zoom in on the 3 most critical ones. First up, we have delta. This measures the sensitivity of your options price to a $1 change in the underlying stock. For call options, delta ranges from 0 to 1. So a delta of 0.5 means if the stock goes up by a single dollar, your option goes up by 50 cents. Simple, right? For puts, it ranges from 0 to -1, which indicates that exact same directional strength, just in reverse.
Our source material gives us a truly fantastic analogy to make this stick. Think of delta as your speedometer.
Just as a speedometer tells you exactly how fast your car is moving forward or backward, Delta tells you how fast your options price is moving in relation to the stock itself. It's your real-time indicator of directional speed.
Building right on top of that, we have Gamma. Gamma measures the rate of change in an option's delta. See, delta isn't just a static number. It actually shifts as the stock price moves. So Gamma tells you how rapidly that delta is going to shift. It's essentially the sensitivity of your sensitivity.
So, if delta is your speed, gamma is your car's acceleration. A low gamma means your option slowly picks up speed over time, but a high gamma, that means your option is incredibly responsive to market twists and turns. It accelerates rapidly, just like a sports car hugging the curves on a winding mountain road. It really tells you how punchy and precise your trade is going to feel.
And then there is theta. Theta represents the completely inescapable force of time decay. Because options have an expiration date, the clock is quite literally always ticking. Theta measures the exact rate at which your options value drops every single day, assuming all other market factors stay perfectly flat. It's simply the cost of time.
To really visualize theta, our source compares it to a piece of fresh, perishable fruit. When you first buy an option with plenty of time until it expires, it's fresh, it's firm, and it's valuable. But as you get closer to that expiration date, the option starts to rot, losing its time value. And that decay actually accelerates the closer you get to the end, until it spoils completely. Understanding that options act like rotting fruit is actually the perfect segue into our next topic.
Section 4. Buying versus selling.
This dynamic is fascinating. Buying an option is basically like renting a house. You pay your premium up front, your financial risk is 100% limited to that premium, and you get the flexibility of living there for a set period of time. Selling an option, however, is a lot more like owning the house. You collect the premium, the rent, from the buyer. But with that nice little income stream comes the absolute obligation to fulfill the contract. You are taking on the massive maintenance risks if the market decides to move against you.
Let's put this all together in Section 5, Basic Option Strategies.
Let's look at a really popular strategy known as the short strangle. First, you find a stock that you expect is going to stay pretty flat. Then, you step into the role of the house owner. You sell an out-of-the-money call, and you also sell an out-of-the-money put. By doing this, you are effectively collecting rent from two different tenants at once. As long as that stock doesn't move drastically outside of your strike prices, you profit purely off the rotting fruit of theta decay as time runs out and the options lose their value.
So, now that you know you can use a financial speedometer to track your movements and leverage the decay of a perishable piece of fruit to outmaneuver the stock market, what strategy are you going to explore first? Whether you decide to rent a call to catch a massive upward swing or act as the landlord collecting premium on a quiet, flat stock, the tools are officially in your hands. Thanks for hanging out with me for this explainer, and happy strategizing.